Understanding luxury taxes, an in-depth analysis. Luxury taxes, levied on non-essential goods and services that cater primarily to affluent consumers, occupy a unique niche within the tax ecosystem. These taxes have gained popularity as governments explore new avenues for revenue generation and seek strategies to balance economic inequities. In this article, we'll delve deeper into luxury taxes, their implications, historical context, and the politics surrounding them. What is a luxury tax? A luxury tax is a form of consumption tax designed to extract additional revenue from individuals purchasing high-value items. Differing from ordinary sales taxes that apply universally, luxury taxes specifically target items perceived as non-essential or those accessible primarily to wealthier individuals. They may be imposed as a percentage of the purchase price, or specifically on the amount above a predetermined threshold. Key characteristics. Specificity. Unlike sales taxes that are universally applied, luxury taxes focus on specific products, targeting high-cost items such as luxury vehicles, yachts, private jets, and fine jewelry. Social equity. As a tool for redistribution, luxury taxes aim to address income inequality by placing a financial burden on the affluent while ideally benefiting lower-income populations through funded social programs. Behavioral influence. These taxes may discourage excess consumption of luxury goods, aligning with broader environmental and sustainable consumption goals. Categories of luxury taxes. Luxury taxes generally fall into two categories. 1. Sin taxes. These taxes are imposed on products like alcohol, tobacco, and gambling activities. The goal here is dual-fold, discouraging consumption of potentially harmful products while generating revenue. Unlike traditional luxury taxes, everyone pays these taxes, irrespective of income. 2. Wealth-centric taxes. Faced exclusively by high-net-worth individuals, these taxes are levied on luxury items. Governments may extract higher financial contributions from affluent individuals as they possess the means to absorb the additional expense. Historical examples of luxury taxes. Luxury taxes are not a modern invention, their historical application can provide insights into their effectiveness and challenges. A notable historical example is the window tax imposed in England in 1696. It charged individuals based on the number of windows in their home under the assumption that larger houses had more windows, thus generating more tax revenue. Wealthy homeowners, however, would often seal up their windows to avoid the tax, leading to negative health outcomes. The window tax was eventually repealed in 1851. Common examples of luxury taxes. Luxury taxes can cover a wide range of high-value goods and services. Examples often include luxury cars, high-end automobiles, including premium sedans and sports cars. Yachts and boats, luxury watercraft that are often associated with affluent lifestyles. Private jets and aircraft. Personal aircraft ownership typically correlates with high-net-worth individuals. Jewelry and watches, high-value luxury items, often acquired as status symbols. Art and collectibles, valuable art pieces, antiques, and other collectibles can also be subject to luxury taxes. Fine wines and spirits, expensive liquors and beverages can incur additional taxation. Case study, Federal Luxury Tax of 1991. The U.S. federal government implemented a luxury tax in 1991, applying a 10% tax on various luxury items. However, within 2 years, it was repealed due to unintended consequences that included a downturn in related industries, such as the luxury car market. This case illustrates the fragile balance between revenue generation and economic impact on businesses and consumers. The rationale behind luxury taxes. Governments pursue luxury taxes for various key reasons. 1. Revenue generation. Luxury items often represent a notable revenue opportunity, primarily if the buyers are affluent. This additional funding can be directed toward essential public services like education, healthcare, and infrastructure. 2. Social equity. a political aim of luxury tax implementation is to tackle widening income inequality by redistributing wealth. Money generated from luxury taxes can fund programs intended to assist lower-income individuals. 3. Discouraging excess consumption. By imposing taxes on luxury goods, governments can discourage irresponsible consumption patterns, particularly concerning environmental sustainability. For example, higher taxes on gas-guzzling vehicles can encourage the shift towards electric or more fuel-efficient options. Criticisms of luxury taxes. Despite their rationale, luxury taxes have their critics, who argue that economic inefficiency, luxury taxes can reduce overall consumer spending in affected markets, potentially harming businesses that cater to affluent clientele. Should high taxes lead to lower sales on luxury vehicles, the broader industry supporting these goods, including manufacturing and service sectors, can face job losses. Tax evasion and avoidance. Wealthy individuals might seek alternatives by purchasing luxury items in jurisdictions with lower taxes, ultimately undermining the effectiveness of luxury taxes. Administrative challenges. The complexity of defining luxury items and enforcing tax regulations can create legal challenges, complicating enforcement and leading to inefficiencies in tax collection. Sales tax versus luxury tax. While both sales tax and luxury tax fall under the umbrella of consumption taxes, they differ significantly. Scope. Sales tax is broadly applied across most consumer goods, while luxury tax targets a specific segment of high-value items. Purpose. Sales taxes serve to generate revenue from all consumers, whereas luxury taxes aim to create a more equitable tax system. Impact. Sales tax can pressure lower-income families disproportionately, while luxury taxes target wealthier citizens, ideally redistributing funds toward public services. Legal strategies to minimize luxury tax liability. For affluent consumers looking to navigate luxury taxes legally, various strategies can be employed. Purchasing in lower tax areas. Buying luxury items in jurisdictions with minimal or no luxury taxes can reduce overall tax exposure. Timing purchases. Taking advantage of tax holidays or exemptions can help mitigate luxury tax burdens. Business deductions. If luxury goods serve business purposes, they may be deductible as business expenses, providing tax relief. Second-hand purchases. Purchasing pre-owned luxury items might allow buyers to avoid luxury taxes altogether, depending on local laws. Engaging tax professionals. Consulting qualified tax advisors can assist in structuring purchases in a manner that minimizes legal tax exposure. Conclusion. Luxury taxes play a pivotal role in the broader framework of taxation by targeting non-essential goods and promoting social equity. While they offer potential benefits, including revenue generation and behavioral influence, they also present challenges, particularly concerning economic efficiency, consumer behavior, and administrative complexity. As lawmakers consider implementing or revising luxury taxes, understanding the nuances of these levies will be crucial for fostering a balanced and fair tax system.